Welcome, everyone. Today, we're putting on our detective hats and diving into the latest financial results from a company called Abundant Limited. Now, at first glance, the numbers they look really weird, but we're going to dig through the documents together and figure out the real story. Okay, Ben, you ready to crack this case?
Absolutely. Here's our game plan. We're going to start with what we're calling the profit paradox. Then we'll unpack their revenue, solve the mystery of their expenses, and follow the cash to find that aha moment. After that, we'll talk about the company's long-term bet, and finally wrap it up with some key investor takeaways. All right, let's get right to it. The heart of this mystery is a massive contradiction in Abundante's headline numbers. It's what made us stop and say, wait a minute, what's going on here?
Okay, so check this out. On one side, you've got revenue. That's the total amount of money they brought in from sales. It grew by a really solid 11%. That's great. But then you look at the other side, profit, the money they actually got to keep. It fell off a cliff, down 98%. It practically vanished. It's just bizarre to see two numbers go in such wildly different directions.
Exactly. That is the big question, isn't it? I mean, more sales should mean more profit, not this. So, Ben, where do we even start looking for clues?
Well, first things first, let's follow the money coming in. We need to make sure that 11% growth is the real deal. Is it coming from their main business, or is it some kind of one-off fluke?
Right. And the financials give us a clear picture. You can see here the lion's share of their money, over $7.5 million, comes from concrete pumping services. That's their bread and butter. The other slice, waste management, is tiny in comparison. So the health of this company really lives or dies by its concrete business.
And here's the thing. That core business isn't just healthy, it's booming. It grew by more than 12%, all on its own. So the money coming in is strong, and it's coming from exactly the right place, which honestly just makes that 98% profit drop even weirder. The problem isn't on the income side.
Okay, so if revenue is strong, the culprit has to be on the other side of the ledger, expenses. The money going out must have gone way, way up. Let's go hunt for the leak.
You'd think so, but hold on. It gets even stranger. Before we find the problem, look at this. Gross profit. Now, that's the profit you make just from your main operations, before you pay for things like office staff and rent. And their gross profit jumped by a massive 59%. This means they're actually getting better and more efficient at their core job. But here it is. This is our prime suspect. While they were getting more efficient out in the field, their general and administrative expenses just exploded. They shot up by 43%. This is the line item that basically ate all of their profits. Whoa, okay, seeing it on a chart really drives it home. We're talking about more than $500,000 of extra costs in just 1 year. What on earth could be hiding in that category to cause a jump that big? The answer is a big and kind of confusing accounting term, depreciation. Now stick with me here. Depreciation is a non-cash expense. It's like this. You buy a huge expensive machine for your business. You don't count that entire cost in 1 year. Instead, your accountant spreads that cost out over the machine's useful life. So each year, a piece of that cost shows up as an expense, even though you aren't actually spending any new cash. And when we dug into the notes, we found a massive $1.24 million depreciation charge was the main reason for that huge jump.
Okay, a non-cash charge. So looking at the profit number is basically misleading us. To find out what really happened, we have to ignore the accounting quirks and just follow the actual cash. This is where we should find our aha moment. Exactly. And when you follow the cash, wow, the company isn't in trouble at all. It's a cash-generating machine. Their day-to-day business brought in almost $1.5 million in cold, hard cash. That's more than double what they made last year. This is a sign of a very, very healthy business.
So if they're making all this cash, where'd it all go? And boom, here it is, the smoking gun, hiding in plain sight on the cash flow statement. They made a gigantic investment, spending almost $3.8 million on new equipment. This is what it was all about. Okay, so let's connect all the dots and solve this thing once and for all. It goes like this. 1, the business is doing great and generating a ton of cash. 2, they use that cash to buy a whole fleet of new equipment. 3,
That huge purchase created a big non-cash depreciation expense on paper. And 4, that accounting expense is what made the final profit number look so terrible. The vanishing profit wasn't a failure. It was just the echo of a massive investment in the company's future.
You know, this completely flips the script. This isn't a story about a company that's struggling. It's a story about a company making a very deliberate choice. Give up some paper profits today to make a huge bet on growth tomorrow. For sure. And you can actually see the result of that bet right here on their balance sheet. The value of their equipment, the stuff that actually goes out and makes them money, grew from about 4.7 million to almost 7.5 million. They have way more tools in their toolbox now to take on bigger jobs and bring in even more revenue down the road. And get this, Chloe, this is the kicker for me. They did all of this multi-million-dollar expansion, without borrowing a single cent from the bank. They have zero bank debt. They paid for everything with the cash they generated themselves. As an investor, that shows an incredible amount of financial strength and discipline. Wow. Okay, so we've cracked the case of the vanishing profit. Let's wrap this up. Ben, what are the big takeaways for anyone thinking about this company from an investor's point of view? All right, here's the bottom line. First, their main business is strong and growing. Second, they're taking their profits and plowing them right back into the company to fuel future growth. Third, that scary profit drop is just an accounting thing, not a sign of real trouble. Fourth, their balance sheet is rock solid, no debt. And finally, the net asset value for each share, what the company is fundamentally worth, actually went up. So despite the scary headline number, the company is actually in a stronger position than it was a year ago. And I guess that leaves us with the final question for any investor. Abundante is clearly willing to take a short-term hit on its reported profits for a shot at long-term growth. So the question you have to ask yourself is, do you believe that short-term pain is worth the potential for long-term gain? This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.